Let's stay with the markets. Bring in JPM Asset Management Chief Global Strategist David Kelly. So, David, I mean, you heard Bob. Things do seem calmer out there. The financials have been up for a few days in a row. I would just add the VIX, the volatility index on stocks, closing below 20, lowest level since before the banking turmoil started. The MOVE index that everybody's watching on bond volatility has come down from those crazy levels at 200. Does this signal that we've wrapped our arms around the problem and that things are going to be smoother going forward?
Well, for the moment, I think that's correct. But I think that going forward, the problem is that if the Federal Reserve raises rates even one more time, you could have a resumption of this. There is a fragility about some parts of the banking system as the Federal Reserve has raised rates so rapidly. So I feel like they're on thin ice here, and it all cracked around them last month. It seems to have stabilized. But they really don't want to, try their luck here. And so I think they're probably done. And if they are, then we may still have a chance at a soft landing.
What if they're not? GDP is tracking 3.2% for the first quarter. We've still got pockets of inflation. Housing inflation isn't coming down fast enough. Services inflation hasn't really shown much evidence of slowing down. I know people are worried about the banking system, but David, what if they keep raising? There's a case to be made, isn't there?
I don't think there's an economic case to be made. I think what we're seeing is rates coming down. Inflation is gradually coming down anyway. I mean, I recognize that there's some problem with shelter inflation hanging in there, but it usually it'll take a few years to get down to 2% in the normal course of things. What I see that I think is most relevant is wage growth is well below inflation. That tells me that workers really don't have that much bargaining power. And that tells me that we're not going to get this constant wage pushing inflation up. So I think inflation's coming down anyway here. Now, yes, it looks like we're going to get a strong first quarter for GDP. I think it'll be weaker for the rest of this year. But the important thing is, so long as whatever growth we're getting, so long as it is compatible with steadily falling inflation, there is no reason for the Federal Reserve to precipitate either a second banking crisis or a recession. I really think they need to just weigh the costs and benefits here, because the economy is actually in an okay place, and we could just escape without a recession. And why have a recession if we don't need one?
Meantime, we do have some other calls for, say, commodities to go up 20% in the next 12 months. That's UBS today. There is an ongoing discussion about whether or not we wrung enough disinflation out of goods as we possibly could. Do you think China still remains a marginal factor for inflation later in the year?
Perhaps, but I think the Chinese economy is not quite as dynamic as people think it is. And I think they're also trying to sort of grow domestic services spending rather than goods spending. But I think also that the overall global economy is not exactly booming here. We've had a period of very high commodity prices, and that usually brings forth more production and some restraint in terms of consumption. So I do think that we're going to see commodity prices basically move sideways or maybe up a little, but I don't really see a big bounce in commodity prices here. I mean, even if you look at demography, the birth rate is down all over the world. Population is not growing that fast, so I don't really see any reason why there'd be a huge surge in commodity demand. We don't have a huge surge in the global economy, and I certainly don't see that.